Welcome to this Killik Explains finance video. This week, why private investors should stick to regulated markets. Yes, regulations can be annoying. Yes, they can add levels of cost. Yes, they can stop you doing things you might otherwise want to do, but there's a reason they're there. And I want to try and demonstrate why they're so important. Now, why do we have regulations? It sounds like an obvious question to ask, but let's have a quick think about it. Investors will basically try to make as much money as they can. All right, in other words, investors left to their own devices will attempt to rip each other off quite often because that's how markets work. Dog eat dog, strongest survives, and so on. And market insiders within, say, a stock market or a bond market have an automatic unfair advantage. And that is what regulators try and even up in terms of the way they have to deal with private investors. And what's quite interesting is this thing called the FICC Market Standards Board, or FMSB report of July 2018, highlights 7 areas where regulators have got their work cut out within regulated markets. So my message is, if that's keeping regulators busy within regulated markets, just think about how much of a wild west you're entering if you go into unregulated markets without knowing what you're doing and or unregulated products. So watch out. In other words, this is stuff that goes on in regulated markets, hopefully not too often, but frankly, all bets are off as to how often it happens outside those regulated markets. So, in case you're wondering how you could be ripped off, hopefully you're not, here are 7 examples straight from that report. Price manipulation is number 1. Now, there are a million ways to manipulate prices. Lots of buzzwords here: spoofing, layering and ramping. Spoofing, submitting false buy and sell orders for a particular asset. And false means put the buy order in, withdraw it quickly. What you're trying to do is maybe push, ramp the price up in collusion with other players in the market who are all doing the same thing. Basically, those orders all vanish, all right, in the hope that they drag in innocent investors who have no idea that this ramping activity is going on, this spoofing is going on. They could drag them in and end up overpaying for the asset in question. So it's an attempt to sort of rig the market, if you like, using fake orders. Now, that's something that regulators keep a close watchful eye on, but in an unregulated market, all bets, frankly, are off. And this is stuff that a lot of investors don't even know goes on behind the scenes. Circular trading, number 2, going through these quickly. The wash trade is a classic example. So what we're trying to do here is to make somebody who's not part of the insider club think there's a lot of activity going on in this part of the market, when in reality there isn't, because we want their money in our part of the market. So A, an insider sells securities to B, who is acting alongside them, is in on the gig, if you like. B buys them back at the same price. Now, why would you do that? A zero profit or loss trade. It's called a wash trade because it generates reported activity. In other words, it makes it look like stuff is happening, even at zero profit or loss, and that might be enough when it comes to reporting volumes and so on to drag in the innocent, as it were. Number 3, collusion or information sharing. Now, there are loads of ways this can happen, and the report identifies many, but here's an example. Directed trade. So a broker should be aiming for the best price for their clients, but what if instead they're aiming for the best perks for themselves? So imagine a broker is sitting between you and somebody who buys them the best lunches, takes them on the best holidays, whatever it might happen to be, gives them the best financial incentives. What's to stop them directing your trades straight through to their preferred supplier, if you like, in the market? Well, the answer should be regulations, because basically they should be hunting around for the best price for you, not hunting around for the best benefits for them. So in regulated markets, there is a regulator out there trying to make sure that best execution, as it's called, takes place, particularly private investors. In unregulated markets, all bets are off. You may be ripped off without even knowing it's happened. Insider trading, number 4. Now, there's a clue in the name here, if you like. So I cover this in much more detail in another video, so I'm going to keep this short. An insider would be what? A company director. Could be a broker. Could be an analyst. Uses inside information. That is price-sensitive information that's not yet been released to the market, but when it is released, it's likely to move the share price to make a profit or avoid a loss if it's bad news that's coming up. All right? And that is illegal. Now, the temptation is obvious. If you're a company director, you know something bad's going to happen to your company, you own stock, of course you're going to try and act on that information. Human nature. But actually, in regulated markets, that might be a slap on the wrist, to put it mildly. Now, in unregulated markets, this can still happen. It shouldn't happen. It's still illegal. But have you got the same degree of vigilance? That's my question. Number 5, influencing reference prices. Now, reference prices are important because closing prices are set for most assets at the end of a trading session. So on the London Stock Exchange, for example, there are closing prices for each security. Those are important because portfolios get marked up or down to them, and that influences performance. Data influences bonuses and all sorts of stuff if you're talking on a quarterly basis. So, because portfolios are marked up and down to those prices, there is an incentive for key players in the market to manipulate those prices up or down. And by reference prices, I could be talking about an interest rate like LIBOR or a closing price for FTSE 100 share, for example. So, really important that somebody has a mechanism in place to stop that happening. Now, on the London Stock Exchange, there's quite a sophisticated auction system at the open and the close that hopefully limits the ability to do this. But watch out, where you don't have such a well-developed, mature system for setting closing prices, the scope is there. And in less liquid markets, the scope is definitely there. Improper order handling. Number 6. What could that be all about? Front running is another way of describing it if you've never heard of it. This is the idea that a broker may have a string of clients, some are favoured over others. So how can you favour a client? Well, one way is basically if you know a big player in the market, a contact of yours is about to put a massive buy order through, you can position your favourite clients just ahead of that, get them in the hope that the buy pressure sweeps prices up and your preferred clients benefit. You kind of leave your less favourite clients on the sideline, or you book their trades later. All right. Now, you might think, what's wrong with that? Well, it's actually preferring one client over another, which is human nature, but in a market that's supposed to be fair and balanced and unbiased, it's not allowed. It's a breach of the rules. All right. So, again, regulators keep an eye on that in regulated markets. In unregulated markets, where regulators are less active or not active at all, watch out. Finally, misleading customers. Now, there are a million ways, unfortunately, to mislead a customer. Market participants have an information advantage, as it's called, naturally. So, making false guarantees, just a few examples. So, pretending that the risk of a loss is lower than it actually is. Window dressing or marking the close, a variant of something I talked about earlier. And misrepresentations about levels of risk, about the risk of loss, about how a product might perform, about anything, frankly. Well, in a regulated market, the temptation might still be there, but at least you've got regulators watching it like a hawk and trying to stamp it out. In unregulated markets, you are to some extent entering the Wild West. You take the risk if you're prepared to do so and you think you know what you're getting into. So, closing thoughts. Regulated markets are not perfect. Regulators don't get it right all the time. They don't catch everyone doing everything, but at least they're there. So if you want a relatively good night's sleep, as a private individual, as a private investor, it makes sense to stick to regulated products and markets. All right, they do offer a minimum level of investor protection, and without this, you are frankly at the mercy of other market participants. All right, and that's the point. If you've never come across those 7 don't do's that I just mentioned, then be aware that those and more represent all the ways insiders can potentially get one up on you. Find out more, editor@killik.com, or for a copy of the report I mentioned, editor@killik.com. And if you'd like to see videos that take some of those things like insider trading into more depth, then it's killik.com/learn.